Hello and welcome to the Private Capital Podcast. I'm Joe Riley, head of Circulus Group, which is a forum for the family office world. We are hosting our first family office event in New York on September 19th. If you are a single family office and would like to attend, you can request an invite on our Substack, which is at circulus.substack.com. There's a link available under events and will be included in the show notes. We're happy to have Steve Tannenbaum of Golden Tree, Torsten Slok of Apollo, and Zoe Cruz from Menai Financial joining us, where we'll cover private equity, fintech, and the global macro outlook. I hope you can join us. Greg Fleming is the president and chief executive officer of Rockefeller Capital Management, a role he has held since the firm, formerly known as Rockefeller & Co., launched in March of 2018. Prior to Rockefeller, Greg was the president of Morgan Stanley Wealth Management and Morgan Stanley Investment Management. Prior to joining Morgan Stanley in 2010, he served as president and chief operating officer of Merrill Lynch and previously ran Merrill's global investment banking business. Greg joined Merrill Lynch as an investment banker in 1992, and prior to that, he was a principal at Booz Allen. Greg is a Phi Beta Kappa, summa cum laude graduate of Colgate University with a bachelor's degree in economics, and he received his JD from Yale Law School. Greg and I discussed the pivotal Lehman weekend of September of 2008, when he was instrumental in the sale of Merrill Lynch to Bank of America, his thoughts on organic growth and mergers in wealth management, the founding of Rockefeller Capital with Viking and building on the legacy of the Rockefeller family office, growing from $18 billion to $140 billion in assets under management in 6 years, and his belief that nice guys can finish first. Please enjoy my interview with Greg Fleming.
This podcast is for educational and entertainment purposes only. Anything said by the guests or host should not be construed as legal or investment advice. Thanks for listening.
So, Saturday, September 13th, 2008. It's about 70 degrees and a little overcast. Your alarm rings. Tell us what happened after that.
Saturday, 13th, 2008, I'm not sure I needed to set an alarm. That night, Friday evening, I got home and it was clear that we were facing a historic weekend in my eyes. And in fact, I told a number of people that during the day on Friday. We'd had a board call at Merrill Lynch that morning with our board. So when I got home late Friday evening, and it was late, 11 or 12 o'clock, I remember thinking that the next 48 hours are going to be pivotal in the financial industry. I was convinced that despite the fact that Merrill Lynch was a tremendous franchise, and we can talk about that in a second, we had a 49% ownership in BlackRock. We still owned, until that summer, 20% of Mike Bloomberg's company. It had a great wealth management business, a very good investment bank. Despite the fact that Merrill was a wonderful franchise, I was convinced that we would need to find a partner that weekend, or Merrill Lynch would be at risk starting on Monday of the following week, the 15th. And at that point, I had a long history as an investment banker, working with senior executives across a whole series of situations where I was the advisor and the key advisor to the CEO. So I knew the value of a weekend in the deal business, and the difference between Friday evening and every other evening once Monday came, all the way till the next Friday.
What is it about investment banking that it always ends up happening on the weekends?
You have the 48 hours. Markets are closed from Friday 4 o'clock until Monday morning. And the extra time you can take advantage of to actually put a deal together over that period, and it's very hard to do overnight during a week. So weekends are where it all comes together. And there are many deals that are in the red zone, close to being done, that get finished on a weekend as well. So it's not you start from scratch. We virtually started from scratch with B of A on Saturday when we engaged them. Now they knew us for a long time. They were interested in Merrill Lynch for a long time, but the negotiation really was Saturday and Sunday. Even though we were able to get that done, I don't know that happens when markets open the following week. And the reality is markets ended up being so bad on Monday after Lehman filed for Chapter 11 then Merrill would probably not have gotten through the day on Monday with the cash we had on hand and the situation we were in. Saturday morning, I was up at 5. I slept, if anything, briefly and intermittently.
And what was that day like? Well,
the day started with me finalizing a few notes I had written during the night. And I remember my wife saying to me, "It's Friday night. You're usually exhausted on Friday and you sleep. Why are you not asleep?" And I said, "This is not any Friday night I've been through in my life." And during the night, I had been working on the points I wanted to make with John Thain, the CEO of Merrill Lynch at the time, on why we needed to engage in a negotiation with Bank of America immediately on the potential sale of Merrill Lynch. So I finalized those and I had them on a note. And I called him at 6 a.m. And he answered and he said, "I'm jumping in the shower. I'll call you right back." And then he called me back. He was heading to the Fed, where all the CEOs had been called by Paulson, Bernanke, and Geithner. And he wanted me to join him. And I said, I don't want to come there. I want to focus on Merrill Lynch. We have to get Ken Lewis to come and meet with you today. And I'll never forget his first reaction. He said to me, "You're panicking." I said, I don't think so. I said, "This is our window." And he went through good arguments around, we own half of BlackRock. We have the best wealth management business. There's no reason our stock had closed at 17 on Friday. Mm-hmm. There's no reason our stock should be run down the way Lehman's had been, Bear Stearns earlier that year. Our cash position was strong. And I said, none of it's going to matter if Lehman doesn't get out of this weekend and if things get a lot worse than they really could. So we went back and forth, and he said to me, "I'll call you from down there." He hung up. I had no resolution. Nobody was calling B of A. So I called Ed Herlihy, who's a good friend of mine, was then, still is, great law firm, Wachtell Lipton. And he was counsel to Ken Lewis and Bank of America. And I finally got him on the phone. We traded calls. And I said, Ken Lewis should come and talk to John Thain about Merrill Lynch. I know you all are interested in Merrill Lynch. This is the window. And Ed said to me, "You speak for John Thain." And I said, "John and I are talking about this." And I was careful what I was saying because I was trying to convince John as well. And he said to me, "We're not coming. Ken's not going anywhere until John calls him." And I said, "I'm having a hard time getting a hold of Thain." And Ed Herlihy said, great line. Ed has a great sense of humor. I can give him my phone because he's sitting across from me in the Fed, because Ed was there. And I said, okay. So I called Thain. John, I called him again. He called me back. Eventually, I got him on the phone, and he said, "You're really starting to annoy me." Because I said, you need to call Ken Lewis. And he said, "Why don't you just set the meeting up? I'll do the meeting." I said, "He's not coming unless you talk to him." He said, "Why not?" I said, "Because they want to make sure that you're committed to this." And he said, "What am I going to say to him?" I said, "I don't know. Tell him the weather's nice in New York and you want to sit down and talk to him." Eventually, I convinced John to call him. He called Ken. Ken got on a plane, flew up from Charlotte. They met at Ken's corporate apartment in New York, B of A's. And they agreed that the Gregs, Greg Curl for Bank of America and me, Greg Fleming, would talk about a potential deal. John in that meeting had said to Ken Lewis he wanted to maybe sell a stake in Merrill, and Ken said, "I want the whole thing if we're going to do it." And then we were off to the races at that point.
Did you consider selling a stake?
I never did. It wouldn't have been enough. We would have still had the same challenges.
And with the banker's nose, did you folks have a sense for the real trouble at Lehman?
We knew that the balance sheet had real issues. And I knew as a banker that they didn't have a party that could act that quickly. There was only one firm in financial services at the time that had done enough deals and was savvy enough on deals that they would be comfortable putting together a deal of that magnitude with all the stakes of that weekend in 48 or 72 hours, and that was Bank of America. There was nobody else. So we were talking to, I was afraid Bank of America would go back to Lehman. They had dialogue. And that was part of my argument to John Thain. If they buy Lehman, we have nobody, and we will be the ones exposed, because the market had been working its way through one firm after another. Bear was the smallest, Lehman was next. It was very clear that the market thought Merrill was after that, and then Morgan Stanley, and then Goldman. And that's how it was working. So Bank of America was the firm that was going to buy somebody, and I wanted it to be Merrill, obviously. So I knew if we were engaged with Bank of America that Lehman was very exposed. They had nobody.
At that point, there was no consideration that the government would come in.
1 or 2 weeks earlier, the government had been clear, Hank Paulson had been clear, that after the Fannie Freddie bailout, there were no more bailouts. They were crystal clear on that. If you go back in the record, you could see that. Because history's clouded that a little bit over the 15-year period, 16-year period now. But the government was not there for a bailout. They felt like the American public wasn't there to support it. That was another argument I was making to John. Nobody's going to help us. We need to get this deal done ourselves.
Do you ever think about counterfactuals, like if Lehman had been rescued?
I think about that sometimes. I'll tell you, so I think about that in the sense that had they been rescued, either if they had been by the government, we could have still done the deal with B of A. If B of A had bought Lehman, we were in a very difficult spot come Monday. But I've thought about different counterfactuals, and I'm not convinced with hindsight that the government wouldn't have bailed out Lehman if they knew what the markets were going to look like on Monday and Tuesday. They really had no choice, as Paulson said, but to step in on AIG Tuesday. He was afraid the whole banking system, the whole financial system was going to collapse. So I think they engage in counterfactuals too. I'll tell you the counterfactual I have spent more time on, and that's part of what led me to want to build Rockefeller Capital Management, is Merrill Lynch. Merrill Lynch at the time owned 49% of BlackRock, and that was a deal that I helped put together. We sold them Merrill Lynch Investment Management in 2005 and took back a 49% stake in BlackRock. And I went on the board with, at the time, our CEO, Stan O'Neill. I had a long history with BlackRock at that point. We had taken them public in 1999 at $14 a share. So I've known Larry Fink since the mid-90s, and he remains a friend and mentor to this day. So we had 49% of BlackRock. Before that summer, we still owned 20% of Bloomberg, another tremendous company. We had arguably the best wealth management business and the top 3 institutional business. So when I think about Merrill, had it made it through the crisis, Merrill could be a $200 or $300 billion company today, because 2 of their assets, BlackRock, 49% of BlackRock, I believe, is worth approximately $75 billion today, and 20% of Mike Bloomberg's business is worth quite a bit. So Merrill could have come through that had we not had all that balance sheet risk on the fixed income side and be thriving today. So that's a counterfactual that I have thought of. I'm still pleased we did what we did because we did have all that balance sheet risk and we did need to do it. But that balance sheet risk was unnecessary for most of what had been built at Merrill Lynch. And it was a 95-year-old company that it was a great company with a long-standing culture that ought to still be around today. So that's part of what spurred me on after I left Morgan Stanley to look for something like Rockefeller that we could build in a way that would create a best-in-class institution that could exist and be around for a long time.
So let's talk a little bit about wealth management as a whole. Maybe just keep your banker's hat on because there's so many interesting questions about it. I'm curious, what's the trick to valuing asset management businesses? How do you get to the real valuation?
Joe, I'm going to distinguish a little bit asset management and then wealth management. So asset management is a business I'm quite familiar with. I worked as an investment banker in that industry starting in the 1990s at Merrill Lynch. And that's really how I met Larry Fink. Jack Brennan, who ran Vanguard at the time, is our lead director at Rockefeller Capital Management. He's been a mentor and friend for decades. Jeff Shames, who ran MFS at that time, is a senior advisor here at Rockefeller Capital Management, was a senior advisor when I was at Morgan Stanley and is a close friend. I know those businesses really well. Asset management was the growth business, as you remember, in the 80s and 90s. Mutual funds exploded. The long-only business really is a high-growth business. So you valued those businesses on multiples of EBITDA, cash flow, and they were quite highly valued. In fact, some of them still are. BlackRock, still with a premium valuation because of the quality of the firm. I used to talk about asset management as one of the best forms of intermediation because if you build a great company, you can grow the business organically by getting more client assets to manage, and the markets on average go up. So there's an underlying increase in the scale of the business just from being there. Cycle obviously goes up and down, but over time, markets go up. Wealth management, to me today, is the greatest form of financial intermediation. Asset management has become quite competitive, particularly the original long-only business. There's been a major move to alternatives, which you've spent a lot of time on your podcast talking about, which we could get to. And they're still good businesses, but the wealth management industry, particularly for the piece that we're in, high net worth and ultra high net worth investors, mostly American so far, that's a really high growth business. There have been many new clients created in those spaces over the last 10 and 20 years. Our relationship with our clients is mostly advisory. We work with them on a fee-based relationship. We're there to counsel them on everything. We're trying to provide answers and solutions to all of their challenges. That business is a really good business if you can create a set of capabilities that are competitive and differentiated. For me, the wealth management business, I like to add, particularly for high net worth and ultra high net worth clients and families, is a terrific business to be in financial services.
How would you make the distinction? When you're doing valuation, you don't just look at EBITDA.
The multiples, whether it's EBITDA or even earnings multiples, ultimately over time are tied to the growth prospects of the industry, you know that, and then the growth of the company that's competing. We talk all the time at Rockefeller about organic growth, which is the ultimate confidence the client is placing in you as the advisor. They're either giving you more money to advise them on, or you have a new client that comes and says, Rockefeller Global Family Office is where we have our wealth business. That's the brand we use there. Rockefeller Global Family Office, can you now take care of my wealth needs? So if you're growing organically in an industry that's got a great growth trajectory, then the multiple of EBITDA and earnings that if you were a public company you're trading at is among the highest multiples that's going to be awarded in financial services.
There were a number of great companies in play in 2017. How did you land on Rock & Co.?
The name, Rockefeller. We thought, and we've been more than happy with this, even surprised on the upside, that this name is one of the legendary, iconic names, not just in the United States, but around the world. We thought we could build a great business around our partnership with the Rockefellers. And just to give you a sense of the Rockefeller name, there are approximately 300 Rockefellers today across 7 generations. The family patriarch, John Rockefeller Sr., his wealth at the time, on a relative basis in the world he was in, was extraordinary. Some estimate as much as 4% of U.S. GDP at the time, which today would obviously take him over $1 trillion. So tremendous financial wealth. But the second generation, John Rockefeller Jr., really took philanthropy and pushed it. They were the world's first great philanthropists. So the Rockefeller family, on the education front, started in 1884, Spelman College, to educate freed slaves, named after Laura Spelman Rockefeller, 19 years after the Civil War. They've started Rockefeller University, where 28 Nobel Prizes have been awarded. They started the University of Chicago, tremendous school, obviously. On the arts side, they started the Museum of Modern Art, Lincoln Center, the Asia Society. They've donated land for national parks across the country. Acadia, Grand Teton, Jackson, Wyoming was really started by the Rockefellers. And they gave a lot of land and support to the Park Service out there in Jackson. They built a hospital in 1920 in China. That's one of the finest hospitals in China today. The philanthropy goes on. They started a Rockefeller Neuroscience Institute in 2016 in West Virginia. So you take the wealth, you take all that philanthropic effort and investment, and then you take the popular culture. The name has been used in song by everybody from Frank Sinatra to Billy Joel to Jay-Z to Mary Blige. You put it all together and you have a name that people across generations respect. My father is going to be 91. I'm 61. My kids are in their 20s. All of those generations hear Rockefeller and they have respect for it. So that when we heard that we might have the possibility of buying the long-standing Rockefeller family office, Rock & Co., we were quite excited about doing that, and we thought we could build a business around that in partnership with the Rockefellers. They are our partners. David Rockefeller Jr. and Peter O'Neill sit on our board, so they're in it with us, and they're quite proud of what we've done with the family name. The Rockefeller Capital Management is viewed as an excellent company and building a set of capabilities of which they can be proud. But the name Rockefeller was the reason we went with the Rock & Co. family office.
Now, did you approach Viking with your vision, or did it come about organically?
Viking actually approached me, to their credit. I had known Viking as an investor for years, particularly in the Morgan Stanley years. When I left Morgan Stanley, I got a call from Brian Kaufman, who's now leads all private investing at Viking and sits on our board. And he wanted to sit down and talk about possibility of doing something together where Viking would provide the investment capital and I would lead the company and build the team. And there were other private equity firms. At that point, Joe, I had been in the industry 23 3 years, 17 at Merrill and 6 at Morgan Stanley. So I knew all of the private equity firms. I knew the senior leaders at all of those firms. So I was having dialogue with different private equity firms about them working in partnership with me, providing most of the capital for something that I would run. But I was quite impressed with Viking from the start as we sat down and started going through it. They had the same view I did, that wealth management for high net worth and ultra high net worth clients was a great business, particularly if you did it the way we intended to, which we've done, which we'll get to, which is trying to provide comprehensive advice, not just asset allocation and investment advice, but tax and generational planning, wealth strategies, philanthropic advisory. We do all of that here today. And that was our original vision. Rockefeller Global Investment Banking, if you have a business, we'll give you advice on that. Rockefeller Asset Management, we've got strategies there that you're able to utilize as a client through your advisor in an open architecture context. Viking believed in that vision alongside me. They had an investment philosophy that I was quite impressed with. They call it GBGM, Great Business, Great Management. They look for a business they like the characteristics of. They put in place a management team they think is a really good one, and then they tell the management team, you go ahead and execute. We work closely with them on targets and budgets, and we've been remarkably close to the original vision we both set out. But day to day, they leave it to us. They're smart, they're involved in all the big decisions, but they know that nobody could care more than me and my leadership team about how things are going at Rockefeller Capital Management. And we're an experienced, seasoned leadership team. They rely on us to make the right decisions. We don't get them all right, but they know we will pivot and we will, on average, make a better decision than another management team.
Let's expand on the business model a little bit, because you reorganized the firm into 3 distinct sections. So how did you come up with this structure and why?
Some of that was a function of my personal experience over my years at Merrill and Morgan Stanley. I was determined to add investment banking to the mix of things that we did, because I believe then, and I believe even more now, that in the United States, a lot of wealth is created by families that build businesses. And I wanted to have an investment banking capability to provide advice to those families. So when we bought Rock & Co., Joe, it had a wealth management business and an asset management business. There was no investment banking, so we built that from scratch. I also believe from my time at my former firms that if we could build a comprehensive set of capabilities in what we came to call Rockefeller Global Family Office, and if the family comes in and they have a broad cross-section of needs across all the things that I've described earlier, of course investments and investment performance and asset allocation, but estate planning, sophisticated tax advice, and through our wealth strategies group, financial education for the second or third generation, philanthropic advisory will help you set up a foundation with your objectives and your wealth in mind. The boutique investment bank, where if you own a business, we'll give you advice on that. The asset management capabilities that you can utilize. It's all open architecture, though. So you can use the capabilities we have, and we have some terrific ones. But we have an investment platform with many of the best investors in the industry, particularly across the long-only and alternatives that are available through our investment platform for our advisors and their clients. But on the asset management side, we have some terrific capabilities that they can utilize. I wanted those pieces to be interconnected and built into what we have here at Rockefeller Capital Management. So we don't have 3 separate standalone businesses that operate autonomously. They obviously do at different points in time. Rockefeller Global Investment Banking might be providing investment banking advice for a company, and that's all they're doing for the company. Rockefeller Asset Management might be managing money for an institutional client. But oftentimes they come together around Rockefeller Global Family Office, and the capabilities within that investment bank and within that asset management business are often brought to bear for the high net worth and ultra high net worth clients that exist in Rockefeller Global Family Office.
How do you start an investment bank from scratch? I know you spent early part of your career revamping the investment bank at Merrill. What lessons did you learn from that to help you start from zero?
That's a great question. It's great for you to go back, because I was thinking about, as we were coming into my career that I hadn't in a while, and I started as a management consultant after I graduated from law school at Booz Allen Hamilton, and I liked that a lot. It was problem solving. I learned about a lot of different companies in different industries, different geographies. I hadn't done a lot of traveling in my life, and I traveled all over the world advising companies of different kinds. I lived in London for a while, and I liked the problem solving aspect of that. But I left ultimately after 4.5 years because I wanted to operate and manage. I wanted to be the one making the decision, not providing the advice and having somebody say, okay, we'll take this part, but we won't do that part. And that's why I left. And I had gotten a call from a headhunter about a job at Merrill Lynch. And I went in within the municipal finance business as a chief operating officer of public finance there. So I started on the management side. And this is leading me all the way back to your question. So I then, after doing that for a few years, I went and I worked with clients on the investment banking side, which was great because I talked to you about some of the things I did there and the clients that I advised, many of whom became lifelong clients and friends. But after doing that for a number of years, I started getting back into the management side. So exactly what you said. In the late 90s, I was running the U.S. Financial Institutions Group, then the Global Financial Institutions, and I was Chief Operating Officer for investment banking. Then I ran investment banking, co-ran the institutional business. So I had time to work on restructuring businesses and understanding how to build these businesses. So fast forward to Rockefeller, when we're building the investment bank here, I knew the things that we wanted to emphasize and I knew the things that we wanted to avoid. The piece that was most important was the connectivity that I talked about before. Our investment bankers needed to be comfortable spending a good part of their time working with families that own businesses. Those businesses might be smaller. They might be looking for advice, but not ready for a transaction or a deal. And we still need our investment bankers to pay attention to those families because they're our clients and we want to provide them this advice. So under Steve Valentino's leadership today, a lot of the time that those investment bankers spend is working with Rockefeller Global Family Office clients. So we needed to hire bankers that were willing to do that, that found that to be an interesting part of what they do, in addition to doing deals, potentially multi-billion-dollar deals for corporations and big clients. So we recruited with that in mind. We were very focused on bankers that understood that model, that fit the culture. And we talk a lot about horizontal connectivity here. We want the best people across the firm to be working across silos on behalf of clients. We don't have silos here. Everybody's focused on the right thing for the client. Those investment bankers needed to absorb that. And it's not just about the deals that you get done and the bonus that you're going to get in January. It's about the clients that you're working with within Rockefeller Global Family Office, the collaboration, collegiality that you exhibit to Rockefeller Capital Management colleagues elsewhere in the firm. So in building that investment bank, all of those things were as important as finding great investment bankers.
And being willing to work weekends.
In the investment banking business, that's what you got to do. Not all weekends, but there are enough weekends.
So tell us, again, keeping your banker hat on because this is so fascinating. Tell us about the different flavors of expansion capital that are out there and available to folks in the wealth management space. Because there's obviously PE is probably about 90% of the fuel out there, but there's also families, sovereigns, and obviously debt. As a banker, what do you think the pros and cons of these different forms of capital are?
We, as I said, we've been quite happy with Viking as our founding equity partner and continuing majority owner. We brought in the Desmarais last year through one of their entities in Canada, IGM, and they now own 20.5% of our firm. And the way we think about that, Joe, is that we now have two families, to your question about different pools of capital. We have the Desmarais and we have the Rockefellers, because the Rockefellers own a piece of our company as well. And we like that because they understand long-term investing. They understand the nature of the advice that we're providing here. So we were happy, and I've known the Desmarais a long time, so I knew that they believed in the type of firm we were creating. We have shared values. The Desmarais, through Power Corp of Canada, are on their second generation. Paul Desmarais Sr. started the company. He's no longer in the world, and two of his sons, Paul Jr. and Andre, run the Power world today. Paul Jr. was on our international advisory board at Merrill when I was first running the institutional business and then president. And Andre I've gotten to know really well in the last 10 years, and they're terrific. And they believe in what we're doing here and how we're building it, and they're long-term investors. So we families like that. That's not going to be every family, but we're quite pleased with the Desmarais and the Rockefellers. Beyond that, we've clearly been happy with Viking. One category you left out, there's still a tremendous amount of strategic interest in these companies because of what we talked about earlier. Wealth management's one of the fastest growing spaces in financial services, and if you do well there, you can capture a lot of that in your own organic growth, generating a high multiple and a high valuation. So there are a lot of strategics that are still interested in the business.
So merger activity has been robust in wealth management for over a decade. I think there was something like 300 transactions in the last 2 years. Can the multiples that are being paid be justified long term? Like you just mentioned, a lot of this money is in PE, so there has to be an exit at some point.
High multiples are tied inextricably to growth. And if you can grow organically because you've built a great company with a winning model, then I think they're justified. The space is such a good space on a macro level that the multiples are high across the board. Some of that goes up and down with the cycle, the magnitude of the overall space. But growth is, for me, from a valuation perspective, growth is the key. And that's why we spend so much time here talking about growth. If you have a growth company, great people want to go work there. There's opportunities for people to do more, to do other things. It's a wonderful relationship to have with your clients. You're doing a really good job providing them advice so they give you more money to take care of, or you get a new client, or they recommend you somewhere. So the valuation is tied to the attractiveness of the overall space, which, Joe, isn't going to change. For the client base, we're talking about high net worth and ultra high net worth. In the United States, you're going to have more and more of these people. You have more and more of these people around the world. And we've got this name that would carry very well everywhere else in the world. So the space is a great space, and that's not going to change. And the really successful companies that are able to achieve high levels of organic growth are going to continue to be highly valued.
Great advisors, bred or bought?
What I would say is great advisors are experienced and have been working with high net worth and ultra high net worth clients for a long time. So we're hiring the best advisors in the industry who have a lot of experience working with those types of clients and families. We call them elite advisors, and they really do operate that way. This is not an organization where you want to come and you want to learn to start to work with high net worth and ultra high net worth clients, or where you've got one such client and you're hoping someday to have more. We think great advisors are those who have the experience, understand how to bring the full toolkit, to leverage the full toolkit. Because remember, when the advisor comes here, they might have been working with the family historically more just on the investment side. But we've built all these capabilities that the advisor can leverage now. And we bring all the capabilities to bear efficiently through the advisor. So the family, the client, they want to see the advisor they've been working with for a long time on point. But that advisor can leverage financial education, philanthropic advisory, our wealth strategies group, which is world-class, our asset management team, if they want to utilize them for fixed income or small cap or some of the areas that we've really built great capabilities. They want to work with our investment bankers. We coordinate that all through the elite advisor, but we're looking for advisors that have worked with clients that are our target client base, high net worth and ultra high net worth, complexity, families that have a lot of complexity, and that can benefit because of that from all the different resources that we've built that they can now draw on here that frankly don't exist in a lot of the competitors.
So looking back over your career, is there a difference in the leadership qualities of investment banking talent versus wealth managers?
That's a good question. I think in the final analysis, successful leaders share a lot of the same characteristics, both in wealth management and investment banking, in technology, in government. And I've spent a lot of time now in leadership in my career, and I have clear views on the things that are important for a leader to do to get a great team in place and galvanize them behind a common mission every day. That's why we talk so much about culture here. I had worked at 3 firms before we started Rockefeller Capital Management. I was determined, Joe, when I came here, to create a firm with the culture that I had always wanted to work within. We talk about excellence in everything that we do here. One of my favorite quotations that all 1,350 people would have heard many times is Vince Lombardi, the famous football coach, who's probably been reading or paraphrasing Aristotle on excellence. But Lombardi said, quote, "Perfection is not attainable, but if we chase it, we might just catch excellence. People work really hard here to do a great job. We want excellence in every aspect of how we're trying to work with our clients. If we miss it, we pivot and we want to fix it and go back. So we start with excellence. But we didn't want the focus on excellence and the hard work and the high bar here to not come with a positive working environment. So we talk about collaboration and collegiality. We want employees and people to get off the elevator and want to be in the office. They want to work with other world-class people. It's an upbeat place. One of the quotations that I have worked to disavow my whole career, and there are people who don't agree with this, who are in leadership in different places. But Leo DeRocher, the baseball manager, famously said, quote, "Nice guys finish last." I update that for 2024, which my daughters are happy about and everybody should be. And I say, nice men and women can finish first. And I really believe that. And that's what we have here. But I also tell my children, our team here, young people, when they ask me for advice, if that's what the approach you're going to have, then you want to get up early and work hard so that you can win. Because you want to have a collaborative, collegial, nice working environment. But if that's all you have, you're not going to be around in a corporate context for very long. You've got to have the excellence as well. And you've got to have that high bar. And you've got to have the drive and the tenacity to go after that. We've put that together here. And this is a function of the prior 28 years of my career before I started this.
So staff compensation is a large part of wealth management budgets. Do you think there's a way to increase operational efficiencies while still offering this full suite of services?
You can run an efficient business. You can have, as you're growing, expanding margins, and you can take care of your team. You need to have great technology to do that. In 2024, one of the keys to your question is great technology. We have a world-class technology team led by Mark Alexander, who ran technology for us at Merrill. When I was president, he was head of technology and operations for the whole firm. He stayed on after Bank of America bought it for a number of years, and I brought him over about 3 years ago here. We have a team in Hamilton, New Jersey, primarily, of great technologists, operations team. They work closely, back to horizontal connectivity, Joe, across the firm with the business people. They don't design systems in a vacuum. They design systems with the advisors, with the client associates, and with the clients. And this is how it should look. This is what's important. So if you have technology imbued across your business, you can take care of your team, grow top line, and also expand your margins as you're doing that. But technology in 2024 is the key to that.
This firm has grown dramatically since you've taken over. I'm curious what the view from the bridge is like. Has your overall strategy changed a bit?
Our strategy is really consistent with what we had in place when we started the firm on March 1, 2018. But even before that, in 2017, when we were looking at Rock & Co. and working on models on how things would play out financially with Viking, we're quite consistent with what we thought up front in terms of the business that we would build and how it would look over time. We had a lot of experience coming into this with wealth management, with the set of capabilities we'd be putting in place here. We had a pretty clear vision as to how we wanted to do this. That doesn't mean we didn't pivot in a whole bunch of places. If you don't do that, that's its own challenge. But we're on a trajectory that we identified up front. And that focus, Joe, from a growth standpoint, was on the United States. We wanted to take the name Rockefeller and build it out across all the major wealth centers in the U.S. And we've done that. We're in about 30 wealth centers now, 50 offices. We started with 3 offices. So that was really the core of the strategy, which was to put a footprint in place in these major wealth centers with elite advisors, leveraging all the capabilities I talked about us having built. That was our original vision. So we've been executing on that since we started the firm, but that plan has been in place now for 7 or 8 years.
Are there any drawbacks to scale, though?
At some point, yes. We have a high-touch model for clients and across this whole horizontal connectivity. So our wealth strategies team works closely with our private advisors on many clients. But that team needs to be out visiting those clients with the advisors across the country. If you just keep growing indefinitely and you're talking tens of thousands of employees and millions of clients, it's very hard to utilize the strategy that we have in place. So when we started, we talked about building out in these wealth centers and cities. We just put in place a new target, fresh for you here. We grew from 18 billion in assets in March 1, 2018, when we bought Rock & Co. and created Rockefeller Capital Management. We've grown to north of 140 billion today in 6.5 years. And we believe we can be over 400 billion in assets by 2030. That's with the same formula that we've had in place since we started, which is building scale in each of these wealth centers around the private advisor, and then growing organically with this comprehensive suite of capabilities delivered efficiently through the advisor to the client.
That's huge growth. How many acquisitions is that?
We've brought in approximately 140 teams across those different wealth centers. But that growth is also organic once the team is here. So we have some teams that have tripled their client assets since we brought them on 5 or 6 years ago when we brought our first teams on. Tripled their client assets. So that's organic growth. We have a whole bunch of teams that have doubled their client assets. So this focus on growth, and again, it's not growth just for growth's sake. It's growth where the client benefits the most because we're doing a great job for the client who trusts us with more, or they recommend us to a new client. They say to another family in town, Rockefeller, those people are really good. They're also nice. You should hire them. A lot of that growth is inorganic, as we say, from bringing the teams over with the book of business they bring, but then organic on top of that.
So I guess I'm interested in the history. How's your thinking about staffing models evolved since your time at Morgan Stanley?
Morgan Stanley's it's a different model, as is Merrill Lynch, any of the big firms. It's a scaled model. They're serving millions of clients across a very broad number of different client wealth categories, whereas we're high net worth and ultra high net worth only. The big firms all have advisors that work in that space. That's just a smaller part of the overall business. So our strategy is to stay right with this set of clients. We're not interested in broadening to different client segments, and to deliver the comprehensive services that I've described to you behind the private advisor. That's hard to build in a scaled operation because there are many advisors that aren't working with high net worth or ultra high net worth clients. So you have to make sure that the capabilities that you build for those clients aren't utilized by them. It's a different model. Our model, because it's focused, enables us to ensure that everything that we build here is to support these advisors in serving high net worth and ultra high net worth clients. It's a lot cleaner when it's just the singular client focus as opposed to big scale firms that have many different kinds of clients in many different places.
Do you have any thoughts on the idea of rising allocations to alts and wealth management? Is this a sustainable long-term trend?
For the clients that we work with, absolutely. And in fact, we think there will be, here at Rockefeller Capital Management, our clients will have a higher and higher percentage of allocation of their wealth to private investments, alternatives of all different kinds, including direct investments and alternative investments that are exclusive to Rockefeller. We talk to a lot of alternative providers, and we're looking for investments that fit our clients' needs, that are exclusive to us and our clients. So we have an investment product and solutions group led by Chris Kirk, who's somebody we recently hired from Wellington. He spent the last 20 years at Wellington as a partner there. He worked with me in the financial institutions group at Merrill in the late 90s. He wanted to move to Boston with his family, and we kept in touch, and I just brought him back, and he's now running that effort for us. That's a very important effort, because not only are we going to continue to bring on new clients, but many of our clients will continue to alternative investments in an open architecture context. So we'll be using the best firms we can find who bring the best product, often exclusive to our clients across the spectrum of alternative categories.
What's the state of play in the ESG space?
ESG, I have millennials and Generation Z as my children are and their friends are. We believe that ESG investing is here to stay for a subset of investors, in particular the younger investors. And I don't think, over the course of my life, I don't think that they get older and they're seasoned and they age out of that. There might have been some things that our generation, at least mine, Joe, the baby boomers, that they might have thought when they were younger and then they got older and it went away. I don't think this is going away. But when I look at millennials and Generation Z, so we want to have a robust set of capabilities there, and we do. There are investors who are less interested in that and more interested in something else, and our job is to manage money in a way, advise clients on their wealth in a way that they're looking for the advice.
You've managed money for many Wall Street titans over the years and worked with them closely. Do you think a lot of these notable investors manage their own personal finance as well?
I think very few noteworthy executives and founders manage their own money and their own wealth because they put so much of their time into building the business that they lead or have founded. And that's one of the reasons that we provide the advice we do to so many different CEOs and founders and entrepreneurs, because they're 100% in on the business, and then they've got their personal life and they spend less time on their investments, and as they start to get older, how to diversify and how to take advantage of gifting and tax rules and things like that. We spend a lot of time with them on that. I like to say one of the reasons why we have a boutique investment bank, Rockefeller Global Investment Banking, is because we want to be able to provide advice and counsel to the many American families that make their wealth through owning a business. And many of them still own the business. So we want to be able to give them advice on the business. Should they sell? Should they go public? Should they buy somebody? Should they keep doing what they're doing? Whatever they're looking for, we want to provide the best advice. And they're going to continue to run that business, and those families need investment and tax and planning advice as well. People who are really creating something in life tend to focus on that creation, and that's really the center of their universe.
This has been so fascinating. I forgot to ask my background questions. When did you first develop an interest in finance?
I'll go a little bit farther back for you. My family really emphasized education. I'm going to get to your question. My father's father, my grandfather, who I didn't know and he didn't know, he died when my father was 2, graduated from the 2nd grade and went to work in Maine in a small town, not easy circumstances. So my father was the first one to go to college in his family. My parents were both teachers, so they emphasized education. In college, I was an undergraduate at Colgate, where I met my wife. I enjoyed problem solving, and I enjoyed complexity, and I enjoyed economics, including macro. And that led me to management consulting after law school. I was at law school at Yale,
But you didn't want to become a lawyer.
That's because I liked this whole notion. When I found out about management consulting, that's why I was taking it all the way back to college. And when I found out about management consulting, I thought I would really enjoy that, and I did, because it is problem solving. The client comes in and they say, give us advice on this problem. And I love that. And it was fun to do it across different industries, and as I said, different geographies. So that led me to think I want to stay with problem solving and complexity. But I did get frustrated with giving the advice and having it be a book that the executive put on the shelf and said, thank you very much, Booz Allen Hamilton, but I'm going to go a different direction. So after 4.5 years of that, I wanted to get into the management side. I got a call from a headhunter on Merrill Lynch. I went because it was an opportunity to be on the management operating side, and it was a great American company. It wasn't because it was finance. It could have been technology. And I'd worked with a lot of different kinds of companies at Booz Allen Hamilton. So I didn't really pick finance. I liked problem solving. I liked complexity. I did like macroeconomics, and I still do today. And I have a lot of fun with, we have Ruchir Sharma, who's our chairman of International. We spend it, and Jimmy Chang, our CIO, tremendous amount of time on macro and what's happening here versus there. But I went to Merrill because I would be able to operate and be in the leadership on the management side. And it was a great American company, not because it was finance. And then things went well there, and it took on a life of its own. But it easily, Joe, could have been a different story. I tell that to young people today, because young people, first of all, on balance, so many impressive young people today. I get frustrated when I hear people complain about the millennials or Generation Z, because I think they're so impressive. They're trying to change the world in a positive way, and they're all in. And I'm amazed sometimes at the things I see on resumes of college students relative to even my friends and I growing up. I was the paper boy. I washed dishes. I was working at a grocery store. You have people saying they're providing advice to some professor at Harvard after a freshman year of college. There's lots of things that young people do that are so impressive. But they'll come in a very serious way, and I'll say, so what happens next? And they'll tell me, I'm going to do this, and I'm going to do this, I'm going to do this, I'm going to do this. And I say to them, I'm not sure what's going to happen along that path, but I have one thing to tell you I'm confident of. It's not going to be like that. Because I was at Yale Law School, and I went to be a management consultant. In 1988, that was an odd shift. Very few people were doing that in 1988. When I showed up at Booz Allen Hamilton, they were like, there's a lawyer here? There weren't a lot of lawyers at any of those firms. I had people wondering if I could do math because I was a lawyer, which I found frustrating because I was always good in math. But that was an unusual pivot. And then I went to Merrill, not because it was a finance company, but because it was an opportunity to manage and to start being part of that, operate. So there's all sorts of pivots in life that nobody sees ex ante. And I provide that advice to young people all the time.
You never thought you were going to end up teaching at Yale, did you?
I didn't. I have a story on that for you, whether you want to include it in the podcast or not.
Yeah,
but
please.
I was there for my 20th reunion in 2008 after we had sold Merrill to B of A. We'd announced the deal. So in October of 2008, my 20th reunion. And Harold Koh is the dean of Yale Law School. He was the top lawyer for Hillary Clinton when she was Secretary of State. Harold's a tremendous man. So bright and such a terrific human being. And he said to me, and if you include this and Harold listens, it'll be funny if he remembers it this way. He said to me, I think my wife was with me, he said to me, you look terrible. You've been through a lot. If you want to take a break and come up here and teach, write, and just catch your breath, you can do that. And I said to him, I appreciate that, but I negotiated the sale of Merrill to Bank of America. I'm committed. And then over the next 6 weeks, I slowly realized that the firm that was going to go forward would be very different than the firm that I had spent 17 years in.
Those are two very different cultures. What did you think about that at the time, and how do you think it's played out now? It's been a long time.
They're two very different cultures. The weekend that you started me with here, I didn't think about anything but survival and having Bank of America rescue Merrill Lynch. I just wanted that to happen because I didn't want Merrill Lynch to be Lehman Brothers. After the fact, after you could start to exhale, it was clear to me there were two very different cultures. But when Harold first said this to me, I thought I was all in. I was all in, but I thought I'd be there for a long time. But it wasn't for me as the onion started getting pulled back.
So what did you teach?
The first in 2009, I taught a class, and fortunately or unfortunately, we didn't tape this. I had a class in the crisis. So I had Larry Fink come up, Alan Schwartz came up and told the bear story, Raj Cohen, who was in the middle of it all, James Gorman came up. And actually, it's interesting because when James came up, I had just left Merrill. He was co-president of Morgan Stanley, but had not been named the next CEO. And we had dinner with our wives in New Haven at Yale Law School. Actually, I don't think it was Maury's. It might have been. The place I go to now is Bar Pizza, which is terrific.
Oh, yeah.
But anyway, we talked a little bit about what was going to happen at Morgan Stanley. Was he going to get the top nod? And we stayed in close touch. And literally 8 months later, he's named CEO, and he calls me 2 days later and says, come here. So the genesis of that was in that we knew each other well, but that dinner. But they all came up and they talked about the credit crisis from their perspective, and it was fascinating because these were all the people who had a front row seat, and the students were captivated. So that was what I did that first semester. And we did it all off the record, which was essential to have people, because there was litigation, there were regulators. And I remember from one of the Yale publications, somebody snuck into one of them and tried to write about it, and we had to work hard to get that pulled because these people were all speaking about it. It was quite a big topic of conversation well into 2009. President Obama talked about it. But that's what I taught at first. And then over time, I've taught classes in financial markets. We've taught classes in ethics. I teach often with a great professor up there I'll give a shout out to named John Macy, who's a legend in corporate law at Yale Law School. He and I do a lot together now. And I will proudly say that my oldest daughter is going to be a third-year law student there this fall.
Well, congratulations.
Yeah, we continue.
Not ever felt tempted by the academic life, Greg?
Joe, I've thought about a lot of things, but when I left Morgan Stanley, I did not want a third run at another big firm. I had done two great firms. I wanted to have the opportunity to lead something, and I wanted to do it on a more entrepreneurial basis. So I was determined to do something like this and try this. Had it not worked as well as it has, I could have thought about a broader career in academia. There's a lot about that I like. And the students are fantastic. Yale Law School has just incredible students. I could have gone that way, but I really wanted to try to take the lessons of my life and my career, both career and life, because the culture here is somewhat tied to the way that I want to see a great firm operate. This notion of excellence, but collaboration, collegiality, and I want people to be energized. I believe in positive leadership. I think human beings look for it. So I wanted to take lessons of career and life and apply it and try to create something like this before I thought about anything else. And then we heard we could get this incredible name, Rockefeller. And that was it. I zeroed in on that. And what's interesting, Rockefeller, Rock & Co., the family office that we bought, ended up being advised by an investment banker I competed with for years at Goldman named Don Truesdale. He was representing them. And Truesdale and I had 20 years of competing in Goldman Merrill. So it's a small world. But that's really what I wanted to do. And now that we're where we are, we've got a great firm with tremendous momentum. I'm very focused on having it get to a stage, both in terms of ownership and scale and capabilities, where at some point I, like everybody, moves on and it goes on and on after me. Because the fact that didn't happen for Merrill Lynch will be a regret I always have. We're building something great and special here, and I want generations of people and clients after me to be able to enjoy this and to thrive within this environment.
Greg Fleming, thank you for joining us and sharing your wonderful insights with us today.
Thanks, Joe. Appreciate it. I've enjoyed it.
Thanks for listening. If you enjoyed the podcast, please leave us a review on Apple Podcasts or share it with your friends. Thank you.